Tell you what, let's kickstart our coverage with spotlight on key tech earnings on Wall Street. E-commerce giant Amazon posted better than expected first quarter results, but issues a soft guidance amid heightened uncertainty around Trump's tariffs. The company, in fact, noted that tariffs and trade policies and recessionary fears are among a range of factors that could make its guidance subject to change. Meanwhile, you do have Apple that has also trimmed its share buyback program by $10 billion, with CEO Tim Cook also telling analysts that tariffs could add about $900 million in costs this quarter as the iPhone maker also shifts its vast supply chain to minimize the impact of Donald Trump's trade war. In terms of results, you do have the tech giant delivering a beat in the first quarter, but by a very thin margin.
Let's keep it with the earnings space then. Microsoft shares rallied on Thursday after the company's quarterly results beat Wall Street expectations. The company reiterated its plan to spend $80 billion on infrastructure in fiscal 2025. Now, several analysts have raised their price targets for the stock, and Morgan Stanley, in fact, called it one of the company's strongest quarters in recent memory. Meta, too, posted stronger than expected revenue for the first quarter. Guidance from the social media giant, too, in line with what the street was expecting.
Absolutely, and shifting focus then to global auto majors, European auto giants reported a sharp drop in the first quarter profit, and many suspended or cut full-year financial guidance as well, partially also attributing the industry pain to US President Donald Trump's trade tariffs. So that is something that we've been talking about thus far as well. Germany's Mercedes scrapped its 2025 earnings guidance and reported sharply lower first quarter profit as well. The automaker, in fact, said that full-year reporting figures could not be estimated with the necessary level of certainty, citing the current volatility over tariffs. When you take a look at Volkswagen as well, did not join the ranks of Europe's top original equipment manufacturers that pulled their financial guidance. Europe's biggest car maker, however, did say that it expects operating return on sales, net cash flow, as well as net liquidity to come in at the bottom end, in fact, of its annual forecasts, citing increasing trade restrictions, political uncertainty, and add to that emissions regulations as well. General Motors, when you take a look at General Motors as well, they've also trimmed its profit expectations for the year. Also see a $4 to $5 billion impact coming in from the tariffs. Germany's Porsche, which is majority owned by the Volkswagen Group, also trimmed its sales and profit margin forecasts. The company, in fact, now expects sales revenue of between 37 billion to 38 billion euros for the 2025 financial year, down from a previous forecast of 39 billion to 40 billion euros for context. And when you take a look at Elon Musk's Tesla as well, that's the one that remains optimistic about its future, targeting millions of autonomous vehicles by the second half of 2025. Also aims to produce 1 million Optimus units annually by 2029. Let's also quickly take a look at motorcycle maker Harley-Davidson's first quarter revenues. That dipped 23% on an annualized basis, and the company, in fact, also pulled their full-year guidance lower on the back of tariff impact.
All right, then let's shift focus to some economic indicators. US GDP has fallen drastically by 0.3% on an annual basis in the first quarter, according to advanced estimates on the back of Trump's trade policies. Now, remember that in the previous quarter, GDP rose by 2.4%. This is the first time in 3 years that the US economy is seeing negative growth. Now, a 41.3% surge in imports is one of the key drivers for this decline. Now, businesses ramped up imports to avoid higher tariffs. Remember that consumer sentiment also remains near 5-year low levels. Meanwhile, US core personal consumption data stays unchanged at 2.6% on an annual basis for the month of March. Consumer prices came in weaker than expected, as economists had anticipated a 0.1% increase on a month-on-month basis. Personal income increased 0.5% compared to February's 0.8% increase.
Well, absolutely. While we're talking about GDP and that plunge coming in as far as US GDP is concerned, we can't not talk about US President Donald Trump and his commentary coming in on GDP. So Trump on his social media platform Truth Social reacted to the GDP data, also said that this Biden's stock market, in fact, not Trump's. That's the commentary coming in. He also said that the decline is not related to tariffs.
Well, absolutely. Let's also turn attention to business activity in the US. The manufacturing sector continued to contract in April, with the ISM manufacturing edging lower to 48.7 from 49 in March. Now, this reading came in better than the market expectation of 48. Meanwhile, the number of Americans filing new application for jobless benefits surged to a 2-month high last week. This is at 241,000 initial jobless claims in the week gone by. Now, this figure is, of course, is much higher than the expectation of 224,000 claims that the street was penciling in earlier.
Absolutely, those were the kind of expectations that we really had. But moving on, then President Donald Trump has said that any country or person that buys oil or petrochemicals from Iran will not be allowed to do any business with the US. Remember that in February, he ordered a maximum pressure campaign against Iran that aims to completely shut down the Islamic Republic's oil exports. The latest comments being read into as a threat to China that imports over 1 million barrels per day from Iran. Do remember that this is also a continuation of some sort of commentary and a stance that we had coming in as far as US and Iran were concerned when it comes to oil.
Absolutely strong commentary coming in as far as oil is concerned. But now let's also shift focus to news flow around bilateral trade talks with the United States. Now, latest comments coming in from US Treasury Secretary Scott Bessent. In fact, in a television interview, he said that the US will hold China to agreements they previously signed. Now, he also added that the need of the hour circles around de-escalation of tariff structures, but the move should come from China first. Allaying concerns over uncertainty, he says that the current uncertainty is not here to stay. Now, remember, these comments come in after his comments on Wednesday, where the US president sounded optimistic on a trade deal with India.
If you like this video, then like, share and subscribe to ET Now.